Does gold beat the S&P 500? In this episode, we're going to be looking at the S&P 500 versus gold. Which is the better investment, and over the period of the last 10 years, what's performed greater? Okay, so both of these are level 1, tier 1 investment vehicles, but which is best? Okay, so we're going to look in this episode at gold versus the S&P 500. Both here are long-term investments. So what we're going to do is we're going to compare the last 10 years of the S&P 500 specifically and gold bullion. Okay, so starting off, let's look at gold. Over the last 10 years, gold has had a yield of 169.41%, whereas the S&P 500 has had a yield of 192.2%. Now that's a difference of 22.8% in favour of the S&P 500. But to put a price on that, when we look at gold's yield of 169.41%, that's a pound value increase on gold bullion alone of 1,311.78 pence. So, in terms of yield over the last 10 years, the S&P 500 has had a better yield of 22.8%. Having said that, I want to look more in detail about the yields, the increases, and the differences between the two investment vehicles, because you can't just look at the yield basis on its own. So, for this example, I'm going to use an invested amount of £10,000. The reason I chose to use £10,000 as an investment example is because I believe anything lower than that wouldn't give us an accurate enough figure basing it on yield results. And honestly, anything above that, we're talking $20, $30, $40, $50,000, £50,000, I think is such a vast amount of money that the average person isn't going to have that amount of capital to invest. So I don't think there would be enough honest and regular data to make those figures accurate. Whereas I think £10,000 is a pretty realistic amount for keen and motivated people who are looking to invest. So let's look at £10,000 invested over the last 10 years, basing it off of those yielded results. Okay, so with gold, over the last 10 years, with a yield of 169.41%, your total improvement on your initial investment of £10,000 would be £26,940. That's a yield of £16,940 over the last 10 years on your initial £10,000 investment. However, when we look at the S&P 500 over the same 10-year yield with the same £10,000 initial amount invested in one go, you would have a total yield of £29,220 on your initial investment, with a yield increase of £19,220. That's the difference between gold and the S&P 500 of £2,280 in favour of the S&P 500. So basing it again off yields alone on a £10,000 investment, we can see that the S&P 500 on capital value alone is going to give you that more income. Nonetheless, both examples would be tax-free yields as well. Of course, you would want to invest in legal tender gold like Britannia's or sovereigns if you're in the United Kingdom to get the benefits of being capital gains tax exempt. And with the S&P 500 being an ISA that you would use to invest it in with your index fund, you can invest up to £20,000 per year. That's £1,666 per month. So again, all of your yields on them investments up to that £20,000 would be tax-free. But even so, for this example, of course, we're using £10,000 as an example, so we're never even going to get close to that, that tax amount on the £20,000 for the ISA. So some valid points to mention for me, and this is an important one, is that I've worked out gold's yield from its spot price. So in fact, gold's yields from these example figures would actually be lower because generically you pay premiums over spot price when buying gold. So therefore, that would actually affect your true yield on gold. These figures that we've gone through would technically be less because I'm working it off of the spot price. However, when you buy bullion, generically you're buying from bullion dealers where you pay a premium. So this would actually make your yield even lower, therefore making a larger difference between the same amount invested between gold and the S&P 500. This is also not to mention that this is if you can get the spot price value back for your gold when selling it. I'm not even including that into the factor. Whereas the S&P 500 has no purchasing fee. There's no premiums to pay when investing in the index fund, the S&P 500. However, the SEC, the Securities of Exchange Commission, do charge a selling transaction fee of, wait for it, 0.0008%. I mean, that's a fraction of when comparing it to the premiums when purchasing gold. So, in conclusion, the S&P 500 versus gold. What have we got to say for it? Well, both are different investment vehicles. There's no doubt about that. Gold is a hedge against inflation and it's the safer investment. There's no way you can argue that gold is not the safer investment. Historically, it's performed more consistently, although the S&P is very strong in itself. Whereas the S&P, though, is not a hedge against inflation, but it is a wealth building tool through compound interest. So over a long period of time, the benefit of gold is that you're hedging against inflation and your money's going up, not down. That buying power is going up, not down. Whereas the S&P is going to build you more money from the greater yields over the last 10 years, but you're not hedging against inflation. So in theory, the buying power is still devaluing because it's not in an asset that's hedging and preserving your wealth. Together though, they make a great diversified investment portfolio. But if we have to look at the straight facts and the straight figures from a 10-year yield, the S&P 500 wins this battle. But let me know in the comment section below what you think. Does gold beat the S&P 500 in your opinion? Do you agree with my facts and my data? Nonetheless, I believe that both are something you should consider having in your investment portfolio for diversification. I hope you enjoyed this video. Thank you very much for watching. And until next time, I look forward to seeing you all in the very next episode. If you've enjoyed it and watched till the end, please consider leaving a comment, hitting that like button, and becoming a subscriber so you don't miss out on more content.